I see precious metals, at least for the next 3 months, being fairly soft. I'm amazed by the apparent strength in the U.S. economy. Make no mistake, I've been through rising interest rates before, and sometimes the impact of rising interest rates, the negative impacts, lag. But I am amazed at the relative strength of the U.S. economy. I think as a consequence of that the Fed can and likely will engineer at least two more 25 basis point rate increases. The near-term impact of that is that other forms of savings and investment assets become more attractive, relatively more attractive.
Precious metals such as gold and silver have a tendency to move independently from other assets, like stocks. They serve as a valuable store of value, particularly during periods of inflation. According to Rick Rule, the founder of Rule Investment Media, it is crucial for individuals to include gold and silver in their investment portfolios due to the unique qualities of these metals. In the June meeting, the U.S. Federal Reserve unanimously decided to maintain steady interest rates to allow time for evaluation and determine the need for future rate hikes. Rule believes that this decision by the Federal Reserve could lead to two possible outcomes. The first scenario involves effectively controlling inflation by increasing interest rates, which would encourage saving and slow down economic activities. The alternative scenario parallels the situation in 1975, when the Federal Reserve initially succeeded in controlling inflation but later changed its approach, resulting in unexpected consequences such as fluctuating gold prices. Recently, gold prices have experienced a downward trend due to investors speculating that the Federal Reserve will keep interest rates higher for an extended period. Rule sheds light on this situation in a recent interview, discussing the impact of interest rate changes on the price of gold. He recalls a previous instance where gold prices declined by 50% within 9 to 10 months, causing new investors to lose faith in the market. However, when the Federal Reserve reversed its strategy, the price of gold began to rise again. This highlights the significant influence that interest rates and monetary policy can have on the price of gold. Rule strongly believes that the precious metals sector will go through a period of relative weakness in the upcoming quarter. In the second quarter of 2023, while the overall asset class saw a modest increase of 0.21%, the average performance of precious metals experienced a decline of 8.34%, with palladium showing the largest double-digit percentage loss. On the other hand, gold was the best-performing precious metal, but dropped by 2% in the last quarter that ended on June 30th. Make sure to watch the interview with Rick Rule on Wall Street Silver to gain further insights. Don't forget to subscribe to our channel to stay informed about the world of finance and make well-informed decisions based on expert insights. To ensure you don't miss any of our videos, subscribe now, turn on post notifications, and share your views in the comments section. Thank you, and enjoy the video.
One scenario is that what the Fed is doing works, that increasing interest rates brings down the level of economic activity to the extent that they engineer a real interest rate, which is to say that, at least by conventional measures, the inflationary numbers are less than the yield available in savings products. In that case, people have a very, very, very long wait. The other alternative is that we're looking at 1975 again, for those of your listeners who aren't quite as ancient as I. In 1975, concerned about inflation, the Fed raised interest rates very aggressively and appeared to be getting away with it for a while. When the impact of those higher interest rates was felt, particularly in the bond market, but also in the equities market, and then in the housing market, the Fed lost its nerve. And had what's now referred to as a pivot. And the consequence of that is, and I think it's important to go over the history in terms of the gold price. In the period 1970 to 1975, before this period of rising interest rates, the gold price had risen from an admittedly price-controlled low of $35 an ounce to $200 an ounce. That six-fold move in 5 years got a lot of attention. When the Fed raised interest rate, the gold price fell in 9 or 10 short months from $200 an ounce to $100 an ounce, a 50% decline. And that 50% decline shook out a lot of the new supposedly faithful. When the Fed had to pivot, gold went on a truly epic run. Went from about $100 an ounce to, if my memory serves me correctly, $850 an ounce. There is no speculator that I can think of in his or her right mind that doesn't understand the speculative setup, if they can stomach the volatility and the risk, that doesn't understand the potential upside in silver years. The point of all this is that nobody knows exactly what's going to happen in the future. Everybody wants certainty, but certainty is not on offer. The point of that soliloquy is that anybody who doesn't own some gold and some silver in their portfolio is a person who necessarily believes, as an example, that the government is on their side. I don't think that's prudent. Anybody who thinks that there is a prudent case for investing in physical gold and silver should consider, with funds where they can stomach volatility and some risk, owning the gold and silver. Companies that have deposits of a size that there's some optionality, meaning if the silver price goes up, that the deposit is large enough to attract real attention. And people where enough is known about the deposit, of 43101 at the very least, that you can construct evaluation metrics using various price points to determine optionality. Those stocks, those few stocks, I think are poised to perhaps not repeat the silver standard and Pan American moves, but certainly they're poised to give enough performance that, put crudely, they satisfy every level of greed that I.
Silver is often characterized as a relatively volatile investment compared to gold, displaying larger price fluctuations. However, Rick Rule believes silver equity can be a highly volatile financial asset. He stresses that determining the appropriate level of silver exposure depends on an individual's financial capacity and risk tolerance. Over the past year, silver prices have ranged from $17 to nearly $26 per ounce. And over the last decade, the fluctuations have been even more substantial, with a low of around $14 per ounce and a peak of nearly $28 per ounce. Looking ahead, the price of gold is expected to exhibit weakness in the next 3 months. This outlook is influenced by the Federal Reserve's intention to continue raising interest rates as a measure to address inflation. The attractiveness of gold to investors may be diminished due to higher interest rates, as gold does not generate income. Nonetheless, gold remains a valuable asset for investors seeking to safeguard value during periods of economic uncertainty. While short-term prospects may be subdued, the long-term outlook for gold's price suggests the potential for an increase. Let's hear your thoughts in the comments section below, and if you found this video informative, please give it a thumbs up and consider subscribing to our channel for more insightful content. Thank you for watching.